Stand in a North Carolina driveway in late August, and you can feel the humidity wrap around you. For Dave, that heat is an afterthought compared to the bright blue tarp currently strapped to his roof. Dave holds a quote from a local roofer to fix the damage for $15,000, but the insurance check he just pulled from his mailbox is for exactly $3,000. Like most homeowners, he assumed his monthly premiums guaranteed that a storm-damaged house would be fully repaired by his provider. Why did his policy deliberately leave him $12,000 in debt? Most homeowners overlook the specific age-related clauses in their policy, walking directly into a financial trap. To understand Dave's situation, we have to look at the specific rules governing his payout. The trigger for this $12,000 gap comes down to one physical detail. Dave's roof was exactly 20 years old when the storm hit. The insurance company calculated his check using a framework called actual cash value. This standard calculates payout based on an item's current depreciated worth, rather than the cost to buy a new one. Under this framework, the insurer only pays the used value of the materials today. They ignore the actual market cost required to perform the physical repairs. This works like a car insurance claim. A totaled 2004 sedan nets you the value of an old car, regardless of how much a 2024 truck costs on the lot. The insurance company applied this same logic to Dave's house, viewing the roof as a rapidly depreciating asset. Dave had an actual cash value policy, so he absorbed the financial penalty for his roof's age. The company followed the contract, but Dave is left with a massive bill. The math of a 20-year depreciation cycle makes this low payout inevitable. This chart shows the baseline value of brand new roofing materials, starting at 100% and declining over a 20-year expected lifespan. General weather exposure, sun, wind, and rain, naturally erodes that initial value year over year. By the time disaster strikes Dave's house at year 20, the remaining value is a fraction of the original price. This highly depreciated value translates directly to Dave's $3,000 payout, which covers the raw shingles and little else. In this model, the labor costs, the most expensive part of the job, are missing from the check entirely. The insurance adjuster followed the mathematical instructions of the contract perfectly. Actual cash value acts as a mathematical formula designed to limit the insurer's liability and shift the financial burden of home repairs back onto the owner. You can avoid this risk by ensuring a different formula applies to your property. You need to confirm that your contract includes these two words, replacement cost. This phrasing legally requires the insurance company to ignore the previous depreciation math. Replacement cost coverage pays for brand new materials at today's market rates, no matter how old the roof was during the storm. It also covers the full cost of modern labor, closing the $12,000 gap that ruined Dave's week. You should review your policy declarations page right now for that specific phrasing. If you cannot find those words, call Layne Insurance in Elkin, North Carolina for a free coverage review. Verifying this single phrase ensures that the next storm leads to a completed repair, rather than a $12,000 debt.